Welcome back to Learn SKN, and today we have an economics video for you. This time we are going to be looking at recession. We're going to be looking at a recession. What causes a recession? How can we help to alleviate a recession? But before that, you know what to do. Like the video, subscribe to the channel, hit the notification bell, and please help us to get to 20,000 subscribers. So tell a friend, tell everybody. If you're not subscribed, subscribe now. All right? So let's just jump right into the content today. We're looking at the recession. Recession. A recession is a period during which the total output in the economy declines. During a recession, firms are producing less, so national output decreases. As firms are producing less, it means that the firm will use less factor inputs such as labor, and this can lead to an increase in unemployment. If a recession persists, it can go into what we call a depression. A recession normally lasts a couple of months to a year. A depression is for several years. And as I said before, a recession is if you have 1 quarter, 2 quarters of continuous, 3 quarters of continuous economic downturn, of a drop in aggregate demand, a fall in output, then you would consider the economy to be in a recession. So if you have, let's say, the first quarter, output goes down, second quarter, output picks back up, then we're not in a recession. But if the first quarter, second quarter, third quarter, you realize output drop, then we can say very well that we are in a recession. And like I was saying, one of the more popular depressions in recent years would have been the Great Depression in America, which occurred between 1929 and into the 30s. And this was basically caused by, in the 20s, you have what you call the roaring 20s in America, the roaring 20s. Everybody just living large. Everybody happy after the World War I finished, everybody happy. And so everybody just living it up. A lot of money spending, a lot of risk being taken on Wall Street, stocks and things like that. I think life was good, right? Until it wasn't. Until you had what you call, I think it was Black Friday, where the stock market just started plummeting. And so that was the start of the depression. And of course it spread across America, across Europe. That was a hard time during the global economy. And this only picked up, as I said before, after the World War II was imminent and the government start, ramping up production on the equipment. Remember, we said that one way to improve demand is for government spending to go up. And so government spending started with the war effort, and I was able to get some of the countries, the nations, out of their recession depression and into more of a boom. So that's an example of a depression in recent times. What causes a recession? So the trade cycle. Economists have observed economic activities over the last 2 centuries. Economic activity increases and then declines over time. This is called the trade cycle. Economic activity will not simply increase all the time. The peak of the activity is called a boom. The trough is called a depression. As the economy slides from boom, this is a recession. A recession signals the end of the boom stage of the trade cycle. At this point at which the economic activity declines, this is the onset of the recession. And you can see it right here in this diagram. So this is another name for this one is what I call the business cycle, right? The business cycle. And so this happens from time to time. Like we said, that the economy can't always be booming. If it stay booming, it's going to overheat. You're going to have major inflation. And so we can't really have that happening. And so naturally, the economy will go through what you call a correction, right? You can only go up for so long before a correction is made. And then you slide into recession. When you bottom out, right? You bottom out at the trough, and you go into recovery, into the boom, and that's the cycle right here on the graph. So boom, recession, the trough here, boom, right? So boom and bust, the business cycle. That's just a part of it. So during a boom, demand is increasing. This increase in demand will fuel inflation, as I said before. As the government puts in place deflationary fiscal policy and monetary policy, this will cause aggregate demand in the economy to fall. Price will stabilize, but there might be a decline in output and a rise in unemployment. This is a recession. So you can see that how a recession can occur. If the government might have gone a little too hard on the deflationary fiscal and monetary policy, that might lead to a longer than expected recovery. So the economy can slide into a recession because aggregate demand would have fallen further than maybe the government was anticipating. So during the boom, when demand is increasing, this can cause this can be a form of a recession. So during the boom, demand is increasing. This increase in demand will fuel inflation. That's the whole point there. Inflation is being fueled. And remember, inflation is a general increase in price levels. But for any government, we don't want that in our economy. We don't want the economy to be overheating. And so they're going to take corrective measures by using deflationary fiscal policy or contractionary fiscal policy and monetary policy and try to reduce the demand. But sometimes it might take a while, and then it might lead to a rise in unemployment, and that can lead to a further recession. So those are some causes of the recession. So the business cycle itself and the increase in demand during the boom, which can lead to inflation, which can then lead to recession if the corrective measures are a little too much. Then we have cautious entrepreneurs might feel pessimistic about the future. This might simply be an instinct that demand will fall in the future. As a result, they may cancel investment plans. They might even avoid undertaking replacement investment. This fall in investment will lead to a fall in national output. So again, a next cause of recession is what we call, in this case, it's producer confidence. The producer confidence isn't high. They feel as though, okay, maybe the economy booming too much. There will be a recession just now. And so they start speculating, right? They start speculating. And then when they start speculating, they start pulling back on investment. And if they pull back on investment, that would mean that the output would not be as high as it should be. That would mean that they might not replace equipment that is needed, and so that might lead to a fall in employment. That might lead to a fall in output, and that would in turn lead to a fall in national output. So therefore, we would have a recession. So when the producers, right, when the producers are too, the confidence is shaken. They're not too confident about the future. They're a little pessimistic about the future. Then they would pull back their investment. That can lead to a reduction in output and thus lead to a recession. So that's from the producer side of things. From the consumer side of things now, the same way. Consumers might have what you call low confidence. Consumer confidence might be low. They might think that, bad times are ahead. And so therefore, they pull back on their spending. And if they pull back on their spending, their demand falls. And so in response to that, companies would have to reduce their output, and so that would lead to a recession also. So the demand of household, firms, and government and the export sector might fall. This will cause aggregate demand in the economy to fall, thereby causing output to fall. Right? So we're talking about demand just being curbed. Not much demand going on in the economy, and so that can lead to a recession. I mean, by definition, the recession is a fall in aggregate demand, right? Because that would lead to a fall in output. And as you can see, the economy is a cycle. It's cyclical. One thing leads to a next, leads to a next, leads to a next. If producers are not producing, or if consumers are not demanding products, then that means that the company shouldn't make as much. If they don't make as much, that means they have to lay off people. And if they lay off people, that means persons are unemployed, got no money to buy anything. And so you see the cycle can continue unless something is done. So another cause of recession, if firms are not making sufficient profits, they will close down. So if firms are not making sufficient profit, they will close down. This will cause a contraction in national output. So that one is clear as day. If firms are not making money, they shut down, and so supply and output would fall in the economy, and so that would lead to recession. Those are the causes of a recession. So what are some of the consequences of a recession? So let's run through them. In a recession, output is falling. I remember what we said last time, national output or GDP. In a recession, GDP is falling. So this means that GDP and standard of living is falling in a recession. Those are some consequences of the recession. The output is falling, so therefore GDP is falling. So your national output will fall during a recession. So the monetary value of goods produced within the economy will start falling during a recession. So that means now that the economy is not going to make as much money as it used to. So what does this mean now? All of a sudden, the government don't have enough money that they had before to do certain things, right? So you see tax revenue falling, everything falling. So therefore, that's why they say here standard of living is falling. Because if the government can't maintain high level of education, health, national security, all that kind of stuff, then that could trickle down into a fall in the standard of living. But I would dare say that this is a little extreme, simply because recessions don't last that long in terms of it's normally under a year. Anything after a year is a depression. So if it goes beyond a year, it's a depression, right? So for a recession, in a recession per se, yes, output would fall on national level, and so you can see the government making less and less money. 2, if output is falling, firms will use fewer factors of production. We said that before. That includes labor, and that means people are going to get turned away. People are going to get sent home. People are going to get laid off, and so that would cause unemployment to rise. So one for sure consequence of a recession is a rise in unemployment. Unemployment on the up because what? Output is falling, demand is falling. Doesn't make sense for the company to maintain the high level of production that they did before, so they let go people. 3, rising unemployment and falling GDP will result in people having less income to purchase goods and services. Therefore, there will be a fall in consumption. So you see everything following in steps right here. If I get laid off, how am I going to get money to buy stuff? So therefore, my demand would fall, consumption would fall. Imagine this is occurring on an aggregate level, right? On the economy on a whole. A number of persons losing their jobs, unemployment high. That means demand is low, so nobody got the money, right? So people had less income because of the recession, and therefore consumption would fall, and so businesses are not going to be making as much money as they did before. Rising unemployment and falling incomes will result in less inflationary pressure in the economy. Prices will stabilize. So who say all consequences got to be bad, right? Now they're saying here that unemployment, falling income can cause inflation to stabilize. But I don't think any government wants it to be that extreme, right? They want the effect of less inflation, but not to that extreme length. But for sure, that is why they would enact certain deflationary monetary policies and fiscal policies to get the prices back stabilized in the economy, right? And so this is a consequence of a recession. The government will find that its tax revenue from taxes on goods and services and taxes on incomes will decline, as I mentioned before. Because of the recession, the government taxes, the revenue will fall, as there is falling income and rising unemployment in the economy. This will affect government's ability to spend on provision of merit goods, such as health and education and other amenities. such as water, electricity. Government will also have to spend more on unemployment-related benefits. So you see what's going on there. Everything just trickling down. Everything happening in a sequence here. One thing trigger one thing, and everything start going downhill from there. So now the government ain't getting enough taxes, no revenue, so they can't provide goods like education, health, those kind of things. And I mean, we all witnessed it this year with the COVID, right? So it's no secret to nobody here. All of us witnessed this whole downturn in the economy this year and last year alone. So we know we could relate to that. In a recession, output is falling, incomes are falling, unemployment is rising. So the only thing going up is unemployment here, boy. This leads to a fall in demand. This might result in further pessimism among entrepreneurs and investors as they predict falling demand. So you see what's going on now. Because everything falling, unemployment going up, investors are now more reluctant to invest in the economy. And so if they don't invest in the economy, how are we going to start to see a rise in demand? Right? So you see, it's like everything is tied. So unless the investors are given some boost in confidence, then the recession will persist. Falling incomes means that consumption will fall, and with the fall in consumption, there will be a fall in the level of imports. So I'm pretty sure if we would have asked KDP and all those places, freight forwarders, how business was like during the COVID time, I'm pretty sure it would have been slow, right? Slower than usual. You see what's going on right now, right? Especially with all of the backlog with the supply chain issues, right? So all those are some consequences of a recession. Keep in mind what a recession is: falling unemployment, falling demand, falling incomes, falling consumption, falling investment. The only thing going up is unemployment. So you can see the fallout from all of these things happening. No money, you can't buy anything, demand falls, so people get laid off because nobody buying anything. So you can see whole link between the consequences of the recession. Right? So all those are consequences that can happen because of a recession. And the thing is, almost all of these will happen if there's a recession. So it's not like you pick and choose. Almost all of them will happen. Output falling, firms letting go people, national income falling, GDP falling, unemployment rising, revenue from taxes falling. So all of these things happen during a recession. So with all that now, the government is not going to sit by and just let the recession happen, right? They're going to do everything in their power to try to combat the effects of the recession. And as we know, the government they have access to two tool sets: monetary policy, fiscal policy. Now they're going to use those in tandem to try to solve the issues of the recession. Because like I said, no government wants to be known as the government that presided over a recession, because the electorate they're going to blame you. When you're feeling that squeeze in your pocket, government going to get the blame. So no government really wants to be over no recession, with no economy in a recession. No matter if it's not their fault or not. All people can remember is the economy was poor under you, and so we make one next president or prime minister. So what can they do? So government policies to reduce recession. Of course, fiscal policy. Reflationary fiscal policy or expansionary fiscal policy. Remember right now, it's a recession. And so the economy is contracting. Things looking bad. The economy is contracting. So now the government wants to expand the economy. So by all means, use expansionary fiscal policy, expansionary monetary policy, or reflationary monetary or fiscal policy. I prefer using expansionary and contractionary, but so expansionary policies. So these policies will relieve the recession. Increasing government expenditure will create jobs for the unemployed. When they receive their incomes, this will lead to increase in spending in the economy. So that's one way. Remember, we said one tool in fiscal policy is government spending. And so if the government increase their spending, that can lead to jobs being created, and that can lead to a boost in the economy. Because now people got money in the pockets, they can run down the road, bang a drink by your shop. You know, the barman can say, okay, I need some more drinks. So they go hit up the breweries, give me some more drinks. Breweries say, okay, barman want drinks. Let's up the production. So let me hire 2 or 3 more people. And then you see the economy start getting back on track. Once you have the successful implementation of the expansionary fiscal policy. Remember earlier I said that there was this joke in economics. It's a joke where they say that anyhow America is in a recession, all they have to do is start a war and then, you know, they're back in things. Because when a war happening, demand for the start new spending, government spending increase. You have to buy more machinery, buy more this, more that. You know, it's not cheap to launch a war. So when they start spending money to buy material, give people more jobs because there's a boost in requirement for construction and this and that. So, you know, you start a little war, you spend some money. You know, normal governments would, you know, start a road project, start a school project, some kind of project. Just start spending money. And that would give money in people's pockets, and that can lead to an increase in demand and help the economy to recover. Also, cutting income taxes and taxes on goods and services will encourage consumers to spend more money. Reducing corporate taxes on profits for firms, will encourage firms to invest more. The increased spending in the economy will encourage firms to produce more. They will employ more labor, and national income and output will rise. So once again, you could see how there can be a trickle-down effect, a multiplier effect when government do certain things. So imagine we're in a recession. What do? Lower the taxes. If you lower taxes or end them altogether, this gives individuals an increased purchasing power. So the purchasing power going up, right? Look at this VAT, they're coming up shortly. Government dropped the VAT from 17% to about 5%, and that would spur expenditure, spur spending from consumers. And that can lead to an increase in output, increase in income, everything. So even if they reduce taxes on companies, on corporations, they can now take that money and invest in the company and try to outfit the company and then increase the job allotment. Now there's a lot of arguments out there about the approach where they reduce taxes for the companies. They had this thing called, well, Republicans in America are famous for it. They call trickle-down economics. They feel as though if you give the rich tax breaks, they're going to take that money, those savings, and invest it and then create jobs for the poorer persons. That hasn't really played out, Because when rich man get a tax break, they pocket the money, send it somewhere else, normally offshore or something. So that flawed philosophy doesn't really apply. On paper, it sounds good. Yes, reduce taxes for the rich, reduce taxes for companies, help them to invest more. But in reality, it don't really happen like that. They take that money, the tax break, and, you know, fly that out somewhere else in some bank account. Right? So those are two ways in which fiscal policy can be used to try to reduce a recession. You can use government spending to increase demand, or you can use taxes, cutting taxes, to also increase demand. So those are two of the tools that can be used. And you can see that everything is linked again. Because if government starts spending, people getting employed persons getting income, taking that income, spending it elsewhere, which would be income for someone else. And so you see everybody benefiting, and you have a multiplier effect on the economy, and the economy can just come out of the recession if it's done successfully. Same way with taxes. Reduce taxes, encourage spending, you might get the end to the recession. So that's using fiscal policy. Now, if you have to use monetary policy, expansionary monetary policy, how does that work? Now, expansionary monetary policy will also relieve a recession. How? Reducing interest rates will encourage firms to invest, and individuals will borrow more and so consume more goods and services. Even governments will have access to borrow at a lower rate of interest. Easier accessibility to loans will also encourage more spending by households, more spending by firms, more spending by government. This will all lead to an increase in demand, an increase in aggregate demand. As aggregate demand increases, firms will increase output. And if they increase output, they would then have to employ more persons. And so you see the economy would start kicking up again. So you can see how everything is linked. Monetary policy. The only thing they have access to right now, one of the best tools would be the interest rates. You see it happen all the time. I've said this before. If you listen to your business news, your Bloomberg, your Fox, your CNBC, you hear them talking about the Fed and the Fed reducing interest rates when there's a recession, when there's a downturn, to try to boost the economy. Because we explained it before when we were looking at the central bank. If you want to boost the economy, reduce interest rates, make money cheaper. And if money is cheaper, more persons are going to borrow it, including businesses and individuals. And when they borrow that money, they're going to spend. They're going to spend on things. So more money is being pumped into the economy. So when they get more money, you know what I say about demand? The more money you have, the higher your demand. So when your income go up, the more your demand go up. So if you get more money in your hand, of course you're going to find more things to buy. And so this can lead to an increase in demand, which can in turn lead to an increase in output, because the firms now have to capitalize on this increase in demand by making more. And if they are making more, they would need more people to make more, and so they would hire more persons. And you can see the multiplier effect right there. They hire more persons, they're getting money. When they get paid, spend that money on other things, and they keep going on and on and on until they reach a peak, and then things looking a little inflationary. We got to go back down the curve now, go back down to the recession, right? So the cycle continues. So those are some of the policies that government can enact to try to reduce the effects of the inflation, to stop the inflation. And again, all of us can see right now in the economy. COVID has shown us all that. A lot of governments, a lot of economies went into recession because of COVID. Real deep recession. And so they are just trying now to get out of it. And so we see all these policies being enacted. We see monetary policy, we see the Feds, different central banks reducing interest rates. We see commercial banks here giving away money almost for free. Unsecured loans left, right, and center. Loans for cars left, right, and center. Loans galore. Right? So we've seen it happening. Government spending, they're spending money on a lot of things, including stimulus packages and all those kind of things. So we've seen it happening right now with the advent of COVID. A lot of these economic things are coming to fruition right before your very eyes. So by all means, you can pull on these real life experiences when you're answering the CXC questions about certain economic topics, because we are living some of it right now, especially the recession, inflation, all that kind of thing. We live in it, right? So you can actually pull on that to answer some of these questions that you're going to get in the future. So that's it for the recession. So we looked at the consequences, the cause, the definition of a recession. And next video, we are going to be looking at unemployment. We're going to follow up the recession with one of the biggest consequences of a recession, which is unemployment. So the only way to know when Learn SKN drops the video for unemployment is to like, subscribe, hit the bell to know when we drop our next video. Alright, so share, subscribe to the channel. Let us get to 20,000 subscribers. Alright, so stay tuned for the next video. Thanks for watching. Thanks for listening.